Okay, so what just happened? The entire artificial intelligence sector just slammed head-on into a massive geopolitical black swan. The story that was all about infinite growth is now, overnight, a story about global risk. Get this, Nvidia drops another quarter of absolutely blowout record-breaking earnings. And what happens? For the second year running, the stock immediately craters. We're talking a stunning 9% drop. So what is going on here? Look, if your first thought is, oh, it's just priced for perfection, you are missing the real story. There was already this undercurrent of doubt building up, and a major world event just came along and lit the whole thing on fire. All right, to really get what's happening right now, we've got to rewind the clock just 1 year, because this isn't just some random stock drop. Nope. This is a fundamental narrative flip colliding with a massive macro shock. You see, last year, the whole panic in the market, it was all about supply. Could they make the chips fast enough? But this year, it's all about demand. And believe me, that single shift changes absolutely everything for Nvidia and the entire AI space. Think back to 2025. The worries were, well, they were pretty technical. Wall Street was sweating the Blackwell chip ramp up, worried it was going to squeeze margins. They were also looking at the super efficient software, stuff like DeepSeek R1, thinking, uh-oh, are companies going to be able to do more with less hardware? But, and this is the key, through all of that, one core belief held strong. The demand for AI chips was basically infinite. No end in sight. Okay, now fast forward to today. That core assumption, it hasn't just cracked, it has shattered. The market is now staring right into the face of Nvidia's new demand problem. And this brings us to a new term you need to know: AI Capex fatigue. I mean, think about it. Wall Street has been watching these hyperscalers. We're talking Meta, Microsoft, Google, spend hundreds and hundreds of billions on AI data centers. And now they're getting real impatient. They're demanding to see a return on that investment, and they want to see it in the form of actual software profits. So the fear today is just a completely different animal. It's being driven by that capex fatigue we just talked about, this intense pressure for software profits, and here's the other big one, the looming threat of the hyperscalers building their own custom in-house silicon. And what's the new core assumption? Demand isn't infinite anymore. It's cyclical. And what this all means is that Nvidia is no longer seen as this untouchable infrastructure monopoly. The market is fundamentally repricing it. Now it's being treated as a cyclical incumbent, a company that faces booms and busts just like any other hardware provider. And that was the shaky ground the company was already standing on before the shock hit. And then, this past weekend, everything changed. The entire macro environment got flipped on its head. A massive external shock just slammed right into this already fragile system. Okay, so here's the event. The United States and Israel have launched Operation Epic Fury. This is a major military operation, and they're striking dozens of targets inside Iran. Let me be crystal clear. This is not some minor skirmish. This is a complete paradigm shift for global markets. What we're witnessing right now is probably the most significant military escalation in the Middle East in modern history. We're already seeing retaliatory strikes from Iran, and the whole situation is just incredibly volatile. So that brings us to the big question, right? How on earth does a war thousands of miles away pose a threat to an AI chipmaker sitting in Silicon Valley? Well, the answer comes down to one thing: the energy grid. See, the connection here isn't some abstract theory. It is a direct causal chain that hits the AI sector right where it's most vulnerable. It's absolutely insatiable thirst for electricity. So let's walk through the domino effect. It's pretty straightforward. First, the Middle East conflict escalates. Second, that threatens a critical global choke point. Third, that causes a massive commodity shock. We're talking global energy prices spiking. Fourth, that spike makes hyperscaler operating expenses just explode, which leads to 5, they are forced to slash their capital spending. And the final domino to fall, Nvidia's order book gets crushed. And the mechanism for all this? It's the Strait of Hormuz. Just to put this in perspective, a full third of all the world's sea-traded oil flows right through that narrow waterway. Any disruption there, whether it's real or even just perceived, is going to cause an immediate and violent spike in global energy prices. No question. And this is where it all circles back to that AI capex fatigue.
Data centers, as you know, use an almost incomprehensible amount of electricity. So with these hyperscalers already under pressure from Wall Street to justify their spending, what do you think an explosive surge in their energy bills is going to do? It's the perfect catalyst. It's the thing that will force their hand. They will cut their infrastructure budgets. And what does that mean in plain English? It means canceling or delaying orders for Nvidia's chips.
Okay, so what does this all mean for you, for investors? The message is simple. We are now entering a severe risk-off environment, and the old playbook, you can just throw it out the window. It's obsolete.
So what is a risk-off environment? It's when big institutional money flees. It runs away from high valuation, high growth assets, things like tech stocks, and it scrambles to find shelter in safer assets. It's a classic rotation, and it's all driven by fear and uncertainty.
So where does the money go? First stop, defense. In times of global conflict, you always see investment in aerospace and defense contractors surge. It's a predictable flight to safety.
Second up, the oldest safe haven asset in human history, gold. It's the classic hedge against exactly this kind of geopolitical instability and the inflation that often comes with it.
And third, you have U.S. Treasuries. When investors are selling off risky assets, they flock to the perceived safety of U.S. government debt. It's just what happens. So here's the bottom line for you. Nvidia's headline earnings, those blowout numbers, they're now irrelevant. Seriously, forget them. If you want to understand where the AI market is actually headed, you have to ignore the old metrics. From now on, you track two things, and two things only. First, the capital expenditure guidance coming out of the hyperscalers, and second, the real-time fallout in global energy markets. That's your new dashboard.
Look, the easy money picks and shovels phase of the AI gold rush, it's over. It's been replaced by the hard, cold realities of geopolitics and cyclical demand. So, with geopolitics now firmly back in the driver's seat, the only question that matters is this: is your portfolio ready for this new reality?